Are you wondering what to expect in the Cincinnati housing market during 2024? Hi, I'm Rhonda with Comey and Shepherd Realtors, and I can't believe that 2023 is almost over. I predicted 3% growth for the year, thinking things would modulate after all the COVID craziness, but knowing that low inventory was still create issues for us. Low inventory was still the main driver of the market, and we ended up seeing 7.5% price growth year over year. So obviously, this is not an exact science, but let's look at some of the factors that could affect our local housing market during 2024. Number one, interest rates. Interest rates have been extremely interesting since the fall of 2022. Now, Zillow and Redfin predictions from November of this year predicted higher for longer. But the Fed cut the rate in December and it just dropped again yesterday, but now predicts 3 cuts in 2024 and 3 more in 2025. Why this sudden change in direction? So I'm no financial guru, but I've been trying to tell people since 2022 that low interest rates are usually a sign of a weak economy. Not really sure where that puts us. However, inflation is almost where they want it. And 1/3 of the federal debt needs to be refinanced. Kind of feel like that's a big deal. Look, if somebody can explain it, please put some comments down below. That way we all can learn. But I digress. So mortgage rates are now in the low 6s and expected to kind of stabilize. They're likely to remain somewhere in the 5s throughout 2024. Some potential buyers will be priced out because they can't wrap their head around what they could afford 2 years ago, and they're going to continue to postpone their purchase waiting on a crash. Apparently, 1 in 4 people are expecting a crash. And hopefully they all live somewhere else because I still don't see it happening here in the local area. All right, number 2, inventory. If rates can stay stable in that 5 to 6% range, we're hopeful. If we just say it enough times, maybe it'll happen, but we are hopeful that some folks who felt kind of locked into that 2.5% rate, maybe they will feel like they have more opportunities, and this year could potentially make a move which would unlock some much needed inventory. Builders are building. They don't have a lot of places to build at the moment, but they are steadily adding inventory. We're also getting 3,300 apartments. I know they're mostly high-end, but even that could help people sell, and then rent while they build their custom home, or they know they're going to relocate. They may go ahead and sell and rent for a while. It also helps people coming in. They don't have to make a decision on a house immediately. And that has been a huge challenge over the last few years. So prices and affordability. Will this ever improve? I know that having 3,300 rental units that, are new seems like a bit ridiculous. Like, who's going to even live in these? Where are these people coming from? What we are starting to see is people moving up to a new or nicer building for rent, and that's opening up some of the older rentals. So as things sit on the market and don't get rented, they're either getting improved or they're getting price reductions. And it's honestly the same with single family homes for sale. Now, that doesn't necessarily mean a drop in prices, but it may be a drop in asking price. Let's take a look at a map from the Bright MLS. I think this sums it up pretty well. Prices falling in those areas that were so hot during COVID. Prices moderating in areas like ours that saw growth, but not the extreme growth that happened in like Florida, Texas, those types of places. So others will possibly see some decreases in prices. We just expect to see slower growth, which is what we really thought was going to happen in 23. So again, no guarantees, but we feel like we are moving toward that average kind of before 2008. Everyone expected 3 to 5% appreciation. That was the normal market. That's what we kind of think we're working toward. All of this hinges on the job market and the economy. Cincinnati is really fortunate to have two extremely large corporations headquartered here that are pretty recession-proof. I mean, what did people spend money on during the pandemic? Groceries and toilet paper. Now, there's also a ton of construction going on, and currently we do expect to see some additional job growth. But in general, I mean, Cincinnati's job market is pretty stable. Let's take a look at the 2023 WARN data map. And it pretty much mimics that price appreciation, depreciation map that we saw from the Bright MLS. Okay, now there are some issues that could complicate our market this year. Did you know that consumer debt is at its highest level ever? It topped $1 trillion in August. What do you think it looks like now that we're sitting here after the holidays? Now, the second thing that really could be challenging is the presidential election. Right now, it's anyone's ball game. Typically, things do start to slow down in the economy as election day nears. This is really a huge question mark because it is such a driver of consumer confidence. There are plenty of other issues. Wars, commercial real estate's a whole thing, countless other possibilities that we can't account for. But if we just focus on residential real estate, let's look at what everyone else is predicting. Anywhere from a 4.1% increase in price appreciation to a 1.7% decrease. The average of all these is 1.5%. Now, this is nationally. I predict that due to the lower interest rates, Airbnbs starting to get pushed back, in some cases even shut down in several of our municipalities. Now there's a bill being introduced to Congress to stop hedge funds and corporations from owning single-family homes. We should start to see a little bit more inventory. Now, if you remember, an even market is 5 to 6 months of inventory when neither seller nor buyer has an advantage. Now, we've been sitting between 3 weeks and 8 weeks, mostly 3 to 4 or 5 weeks for the last several years, honestly, since the pandemic started. I am really, really hopeful that we can get to 2 to 3 months during the first half of the year. And I believe that prices will continue to follow the seasonal curve, reaching its peak in June or July. Then, per usual, start the typical slide back down as everyone starts focusing on the election. Now, this probably will also result in less inventory coming to market October and November, but if we have a clear winner that the majority is happy about, we should start to see things pick back up in December. I'm really hoping we will see more signs of a stable market, like contingent sales contracts that will allow people to sell and buy at the same time, as well as FHA and VA purchases. Less competition, maybe fewer multiple offers will hopefully minimize people purchasing without an inspection, without having to have that additional appraisal gap coverage, and just other things we've been seeing for the last few years. But honestly, it just depends on how many buyers are out there, what they're willing to do to get the property. Right now, we are still seeing some pent-up demand, so please keep in mind if rates drop quickly and lots of people start looking again before we get more inventory, it's gonna be a free-for-all. Honestly, if you find the thing that you've been wanting, you need to grab it now before it gets crazy.